In this video, we're going to talk about the 12 best large cap stocks to buy and hold in your portfolio. So, before we start, please like this video and subscribe to our channel for future updates. Top-rated large cap stocks can offer a bit of security in volatile times. Market jitters on things like inflation, rising interest rates, and a probable recession have not yet been properly internalized. Anyone looking for short-term prospects would find that to be depressing. However, if you invest in highly regarded large cap stocks over an extended period of time, further market volatility can be to your advantage. Similar to how a bull market often drives both high quality and low quality equities to higher prices, a market downturn does the exact reverse. The market can drive top-rated large cap stocks to extremely advantageous price points for buy and hold investors, while simultaneously driving more speculative bets down to values more indicative of their fundamentals. The 12 top-rated large cap stocks that we'll review in this video will demonstrate this. Given that the market is still in turbulent waters, here are our 10 best large cap stocks to buy and hold in your portfolio. Number 1. Abbvie, ABBV. Abbvie, NYSE, ABBV, a significant pharmaceutical corporation, is a fantastic recession-resistant investment to add in any portfolio. Although a recession may reduce demand in many areas, individuals still require healthcare. Having said that, we can understand why there could be some reluctance to purchase ABBV stock at this time. It could appear that the company is currently facing too many challenges, what with losing exclusivity for its Humira rheumatoid arthritis medication and reports that it had to pay more than $2 billion to settle opioid litigation. However, given the stock's present low value, one can argue that these prior problems are already more than priced in with a forward earnings multiple of 10.2x. Additionally, as it expands the range of products it offers, a route to even higher costs may open up. Additionally, Abbvie offers a respectable dividend, 3.9% forward yield, with double-digit yearly growth over the previous 5 years. Number 2. Elevance Health, ELV. Elevance Health, NYSE, ELV, formerly known as Anthem, is the biggest for-profit provider of health insurance under the Blue Cross Blue Shield name. Overall, it's one of the best large cap stocks to invest in for the long run. Even if it's still rising, Elevance Health stock trades at a favorable value as the market retreats with 17.5x earnings. As it's forecast to continue growing its profits per share, EPS, by roughly 12.8% next year and by roughly 13.6% in 2024, it can easily sustain this earnings multiple. Elevance may rise more in unison with rising EPS. Although its forward yield of 1.02% at the moment may not seem like much, over time it might develop into a powerful figure. There is plenty of space for dividend growth due to its low payout ratio, 19.31%. Over the previous 5 years, the corporation has increased its payment by an average of 13.14%. Number 3. General Dynamics, GD. Another industry that can perform well in difficult economic times is defense, much like the healthcare industry. A big reliable name in the defense industry is General Dynamics, NYSE, GD. The business offers the American military a wide range of equipment, from mortar projectiles to nuclear-powered submarines. Investors have already purchased this defense stock as a defensive play, with a year-to-date gain of about 16.5%. While markets as a whole continue to trade in the red, geopolitical concerns have also played a significant role in maintaining the GD stock in the black in 2022. General Dynamics offers a 2.09% yield in addition to a stable value. It belongs to the group of dividend aristocrats, having increased its payout for 27 years running. Consider it a purchase if you want to benefit from both stable long-term price growth and dividend, whether it be now or on any weakened point. Number 4. CocaCola, KO. CocaCola, NYSE, KO, is unquestionably a name that comes to mind when you think about blue-chip large-cap stocks. The storied beverage company has been in operation since 1886, has paid dividends since becoming public 100 years ago, and has increased its dividend 59 times in a row with a current forward yield as 2.7%. You can't go wrong by including a stock like KO stock in your portfolio if you're a cautious investor seeking consistent returns, primarily through dividends. Having said that, you could be apprehensive about its present market value. The expected 2022 earnings per share are currently valued at about 26.5x. Although its price may limit potential gains, its present multiple can be considered fair. Given its exceptional caliber, a premium price is appropriate. Keep it in your watch list even if you decide to ignore it right away. You might be able to purchase it at a discount if there is another market correction. Number 5. Tesla, TSLA. After looking at many large cap stocks that are best classified as blue chip or defensive, let's take a look at one of the top rated large cap stocks that is still on the fast track to high growth. At first glance, Tesla, Nasdaq, TSLA, may not appear to be a good stock to purchase during times of market turbulence. After all, hasn't the bear market crushed growth and tech investments like this electric vehicle manufacturer? The answer is yes. Since January, the shares of Tesla has fallen by around 25.8%. However, while stocks may continue to struggle in the short term, the same cannot be said for the long term. The EV revolution isn't going away, recession or no recession. Indeed, recent adjustments in EV tax incentives may increase demand from middle-class buyers. Add in the possibility of worldwide sales resuming, and its long-term growth prospects remain solid. Because sustained growth may help to maintain and grow Tesla's stock price, purchasing now may be a profitable choice. Number 6. United Health Group, UNH. This list of top-rated large-cap stocks may appear healthcare heavy, but it emphasizes how important this sector is for long-term investors to focus on. The largest health insurance firm in the United States is United Health Group, NYSE, UNH. It's no wonder that UNH stock has performed well, given its constant revenue and earnings growth. With a market cap of more than $500 billion, it may take more than a decade for shares to increase 9x. Nonetheless, as an industry leader expected to continue growing at an above-average rate, investors buying now will be more than delighted with future gains. Paying a premium for quality now, shares trade at 25.1 times earnings, could be worthwhile. Number 7. Exxon Mobil, XOM. With crude oil falling back below $100 a barrel, the party may appear to be over for energy stocks such as Exxon Mobil. Shares of the integrated oil and gas company have recently dropped again in line with the decline in oil prices. Nonetheless, don't see this as a warning that Exxon stock will only provide mediocre returns after its rebound. The U.S. Energy Information Administration, EIA, predicts that crude oil prices will continue at or near current levels, about $89 per barrel, through 2023. Furthermore, as of June 2022, there are other forces at work that might affect Exxon Mobil stock. The company's cost-cutting efforts will enhance EPS. Its ambitious share repurchase program will also help to raise EPS and, as a result, the stock price. With a projected dividend yield of 3.74%, it's still a solid long-term investment. Number 8. Starbucks, Nasdaq, SBUX. Starbucks, Nasdaq, SBUX, has consistently outperformed the broader market since its initial public offering, IPO, in 1992, and it appears ready to gain market share as it rebounds from the pandemic. Starbucks is a wonderful example of a large cap stock with growth potential in China, digital, and delivery, as well as consistent profit sources. The company has significant competitive advantages, such as its well-known brand, popular loyalty programs, and technological efforts like mobile order and pay. Starbucks has experienced difficulties such as a pandemic lockdown in China, a unionization campaign, and a tight labor market in the United States. Nonetheless, the corporation has survived difficult times in the past and should do so again. The company began paying dividends in 2010 and has increased them every year since, positioning it as a potential future dividend aristocrat. Number 9. MercadoLibre, Nasdaq, MELI. MercadoLibre is Latin America's largest e-commerce site and is a great example of a large cap company that is still growing quickly. With its dominant e-commerce company and shipping network in Mercado Envíos, MercadoLibre is similar to Amazon, but it also has unique solutions for Latin America, such as supplying point-of-sale equipment for brick-and-mortar shops. This is one component of the company's rapidly expanding payment mechanism, Mercado Pago. Originally a service similar to PayPal for MercadoLibre customers, it has evolved into something akin to a global bank in Latin America, where it is used to make payments at businesses like grocery stores and gas stations. Number 10. Walmart, NYSE, WMT. Walmart is the world's largest retailer and the world's largest firm in terms of revenue. The company has numerous competitive advantages, including economies of scale that benefit it, a reputation for inexpensive prices, and stores within 10 miles of 90% of the U.S. population. But what distinguishes Walmart from other dividend aristocrats is that it is evolving into more than just a retailer. By opening health clinics, the corporation is utilizing its physical footprint to enter areas such as healthcare. It also launched a fintech startup in early 2021 and poached 2 Goldman Sachs executives to lead it. The company has built a formidable e-commerce business that ranks second in the US behind Amazon, giving it a valuable stake in a rapidly growing market. Walmart, with its apparent evolution, might be a quite different firm in 5 or 10 years. With its reputation for low prices, Walmart is also well prepared to endure a recession or economic downturn. Number 11. Kraft Heinz Company, KHC. When it comes to consumer staples, there is perhaps no more powerful brand portfolio than that of Kraft Heinz. On top of its namesake ketchup and macaroni and cheese, it owns Philadelphia cream cheese, Maxwell House coffee, Jell-O, Kool-Aid and a host of other iconic consumer brands. With prices going through the roof in all corners of the economy, many consumers are cutting back on restaurant visits and eating at home more. That is a huge benefit for KHC, which is why shares have achieved a modest increase in 2022 despite losses for other blue-chip stocks. There is a lot to admire about this grocery store classic, especially when you consider its 4% dividend yield. Number 12. AT&T Incorporated, ticker, T. AT&T saw plenty of volatility over the last year, in part thanks to uncertainty around the spin-out of its media operations into what is now Warner Bros. Discovery Incorporated, WBD. However, shares are up more than 15% since that March split, and even though dividends edged down, thanks to the now smaller operations of the core telecom business. AT&T still yields an impressive 5.4% at these prices. Though T-Mobile US Incorporated, TMUS, is ostensibly a third player in US telecom, it is bloated with debt after its merger with Sprint, and in many ways this industry is just a two-horse race in the US between AT&T and Verizon Communications Incorporated, VC. Now that the dust has settled, AT&T stock looks to have the wind at its back, and in a risk-off environment, the regular revenue from long-term subscribers will give great peace of mind. Which one of these large-cap stocks would you like to add to your portfolio? Let us know in the comment below. Thank you for watching and don't forget to subscribe to our channel for more weekly investing videos.